So audit is about gathering evidence. Audit is about inspection and then gathering evidence to give a conclusion. Very simple. So what auditors does, they work or they go through the financial statements or any other object or subject. They investigate, gather evidence, then give a report, and they have to support that report with evidence. So from there, we are understanding some few things. That number one, in audit, evidence is very important. And so we need to look at the procedures of gathering evidence. Number two, you need to come up with a conclusion or a report. That report for statutory audit is normally called opinion. But we have other audits like internal audit, which you don't give an opinion, right? In internal audit, you just give the findings. Then we also have other audit like forensic audit. You normally do it where there is fraud or some kind of something like that. Maybe there is a fraud. So somebody is trying to call you, or a management can call you to come and investigate. And so the main aim for forensic audit is to know how much has been lost, who are the perpetrators or the people involved, and what were the weaknesses in the internal control system. So that is basically what forensic audit does. But then we have other audits apart from that, which we call special audits. Somebody can call you to audit the environment. You can be told to audit environmental issues, or you audit compliance, right? For example, tax compliance. You can do that. You can also have procedural audit. Procedural audit are where you're auditing the procedures that a company used to undertake their activities. But that one you can put aside. What we need to understand is that in the process of audit, number one, the first thing is that we have audit process. Let me just adjust this. In audit process, we have the first one is accepting engagement. Accepting engagement. So this is where, as an auditor, you need to accept that you're going to do that particular job. That activity that you're going to undertake is what we call engagement. It could be forensic audit or any other type of activity, but in audit we call them engagement. So now there are things that you need to understand during acceptance of the engagement. For example, when I'm accepting your appointment to come and do audit, I'll be able to first do what is called risk assessment. I need to understand the client that I'm going to audit, right? You need to really understand the client, because number one, there are some clients that will expose you to a certain serious risk. So because of that, you want to know that the client that you're going to audit, you can actually reduce that risk to an acceptable level. It will not cause trouble in your profession. So understanding or doing what is called risk assessment, client's risk assessment. Let me just call it client risk assessment. That is at the acceptance level, as you accept the client. Number two, you need to understand the nature of the audit, nature of the client's business. You need to know that that kind of business is something that you have background on, or at least you have some idea you can be able to audit. For example, if you call me now to come and audit manufacturing company, and I'm used to financial institutions, first I need to ask myself, before I accept the appointment, am I able to do it? So when you look at the nature of the client's business, you look at the ability of your team. We call them audit engagement team. From your side, do you have the qualifications? You do have the ability in terms of the capacity and skills, right? You do have the enough staffs that can do that particular job, and do you have the enough skills or experienced staff? So at this level, if you have the skills, or at least you have some staffs, then you can actually accept the job. Another thing that you can look at is the independency or ethical standards or ethical issues, ethical requirements. We call them ethical requirements. So what do we mean by this? This is where you are saying that you need to look at yourself and say that between you and the client, is there any relationship? Are you independent? So you need to look at whether you are independent, Are you independent of the client? So that is basically the ethical requirement that first you need to consider. so that you don't accept a job where after accepting, you have issues to do with independence. You can't stand and give the correct answers or conclusion. So that is very important. So as you accept, then you need to be able to do this. Another thing you need to understand, maybe you can always ask the outgoing auditor. You can ask or confirm with the outgoing auditor if there is any professional reason why you should not accept this job. So you need to communicate. In fact, the best word I should have used, communication with the outgoing auditor. Communication with outgoing auditor. Then you also check whether you have all the requirements, maybe things like professional, legal requirement, professional and legal requirements, legal and professional. In terms of papers, there are some jobs that they require some things like maybe certification. For example, if you're doing forensic audit, you need to be a certified forensic auditor, right? So you check that you have the documentation. You need to check that you have the business permit. You are up to date with the ISPAC requirements like renewal of licenses. So those are things that again you need to check before you accept any job like this. But that is just the beginning of an audit process. So let's just say that you have accepted that you're now going to do audit. What is next? You need now to start planning. You have accepted the work. Now, when you are accepting the work, of course, you are given appointment. You are given appointment, and you've decided to accept that job. You have been given an appointment, and you have accepted that particular job. You accept by giving what is called letter of engagement. Issue, or we can say issue a letter of engagement. And as an issue, ensure that it has been approved by the relevant authority. So this one is just the initial stage at the acceptance level. Check that you have given your client letter of engagement. This particular letter of engagement, basically, it is a letter that the auditor writes to the client that shows terms and conditions for the engagement, right? So if the client agrees with those terms and conditions, of course, they will assign. So they need to sign and give you back the letter. Then now, after receiving back the letter, which has been signed by the client, then now you start planning. So the second stage in audit is planning. So under planning, there are quite a number of activities that you need to do here. Of course, you have done some of them, like risk assessment. So you can also still do risk assessment here. But because we've written it here, at the planning stage, you now need to understand the scope of the job that you're going to do, scope of the work. That's number one. Number two, you need to test the integrity of the client. You need to understand integrity. In fact, at the acceptance, you should have done integrity of the client here. Integrity of the client. So here, you look at the integrity of the staffs, integrity of the management. I want you to understand the differences. We have a client that could be the company itself. So there is the kind of business that the company is doing, right? But then we have people within that particular company, like finance manager. That is not the owner. That is not the director. So when you talk about the integrity of the client, you're talking about the company and the directors, right? But then you look at the competency and integrity and competency of the team. Competency of the team. You might be auditing a company where the staff do not have the skills. There are actually people who do not even understand accounts. So the financial statements are not in order. So when you have accepted the assignment, you need to start planning. But during planning, think about the competency of the team that are handling the books. The management, the auditor, the client could be okay. The client does not deal with some activities that are bad, like maybe fraud or maybe smuggling of goods, or maybe drug trafficking. Those are the things that we talk about when we're talking about the integrity of the client. But the plan is okay and the nature of business is fine. But the team that are employed do not know what they're doing. So you need to think about that. You need to think about the resources that you have during planning, resources required, number of staffs that you need to require, number of staffs, and the skills. So when you talk about number of staffs, you are trying to talk about maybe in terms of the capacity that require maybe something like maybe 30 people, 10 people, or less than that, or even 5. But then do they have the right skills? So at that level, you also think about need for experts. Whether you're going to need the work of an expert, then you need to think about that one at that time. So resources here, we are thinking about things like maybe laptops, networks, maybe money that you're going to spend when you're doing the assignments. Now, after planning, there are a lot of things that we can do during planning. So after planning, you go to the second stage. Now you move to the client. You need to move to the client. You need to move to the client. So when you go to the client side, which is now number 3, that is evidence collection, execution, and evidence collection. So this is where you're going to perform the actual audit process, where you need to perform the audit as you collect evidence. All right. So you execute the actual audit because you are planned and you are at the client site. You execute as you collect every evidence that you get. Now, after that, you come back to the office with this particular evidence and do now what is called review and reporting. Review and reporting. So after collecting the evidence, you come back to the office, review your work, and then give a report. So some cases, you might have reviews number 4 and then reporting number 5. So at the reporting stage, this is where you are now going to give opinion. So according to the evidence that you have, you need to write a report that actually is in line with the evidence. Then at the end of the day, with those topics or those engagements where you can be able to give an opinion, you now need to give opinion. But I told you that there are some that you don't need to give opinion. You only give a report. For example, if you are doing something like maybe forensic audit, you don't give opinion. You only give the report or your findings, and those should be facts, right? So that is basically a summary of audit process. That is a summary of audit process. Now, our main aim here in the last setting, they were talking about opinion. So, which kind of opinions do you have? Which kind of opinions do you have? Audit opinions, which you give during reporting. So opinions are divided into 2 major categories. We call number 1 unmodified opinion. It is also called unqualified report. Sometimes they use the word report or opinion. In exam, they can use the word report or opinion. Either is okay. Now, this one is normally a good report. Why is it a good report? This report, when you give it, it shows that the financial statement represents true and fair view of the company's position. So there are companies' actual financial position on the ground. And then we have the financial statements that you are given in the books that you need to go and audit. So your work as an auditor is to be able to compare the evidence that you're gathering, compare with what you are having in the books, then give an expression of opinion, express an opinion whether whatever you are given is actually a representation of what is actually on the ground. You know, sasa zingine wanasema ati kwa ground vitu ni different, right? So you might be given a good well-presented financial statements, but on the ground they are different. Now that particular opinion, This one shows that whatever you've been given matches what you found on the ground. So that is what we call unqualified or unmodified opinion. Why do we say that it is unmodified opinion? At any given time, the management expects you to give a good report. That is the expectation, right? A standard report should always say that things are okay. That is the expectation. But in case you're going to adjust or put any finding on that particular report, you are basically modifying the expectation. You are modifying the norm. So that is why you are saying you have modified the opinion, and you can modify it because of different results or different categories of issues or different materiality levels that you'll find. So that means that if you don't have a good report, which is a unmodified report, then that means that you're getting the contrary. You are getting a bad report, which is now modified. You are going to modify the expectation of the expected report. So we have number 2, modified report or modified opinion. Modified opinions. Under modified opinions, there are different types of modified opinion. You know, basically you are changing or adding something. Modification means that you are editing, manipulating, or changing. That's what it means. So then that means that if you're going to change, then there's something that you found during audit process. There's something that came to your mind, or there's something that you saw. So what is it? Now, what you're going to modify here depends on your finding, depends on what you saw during your audit process. So that can actually make you give a different opinion depending on the materiality. Depending on the materiality, then you can give the first one is called qualified report. That is the second type of report. Remember, the first one was unmodified, or it is also called unqualified. So let's say that the first one is qualified, unqualified. The second one is now qualified report. Then we have another category called number 3, called adverse report or opinion. Then number 4, we have a disclaimer. Now, sometimes they call this report acceptable. This one, sometimes they call it acceptable. So let's also have this one acceptable. Now, what do we mean here? We say that this one is a good report. If you don't, let's say that you're giving a percentage, so this person is somebody who got an A, right? He has passed very well. So you've given that person a green light, an A, right? But what about the person who has tried? He has not achieved 100% or 80, but he has also tried. That person has some small errors. Ndio maana hajafika 100%. That small error, that is now what we call exception. And that is why it is acceptable. Meaning that it should have been okay. He should have gotten an A, except a few things that has challenged him. And so he's coming down to a different opinion. So that is the opinion that we call qualified. In exam, they know that you should have gone through class and you understand this. So they might not give you qualified, the name qualified, but they call it in its other name called acceptable. It means the same thing. It means the same thing, acceptable. Meaning that things are okay. In fact, that is a good report. Only that can add an element. Ni kama wewe sasa uko mzima, lakini uko na kitu kadogo tu ndio uko nayo hapa kwa masikio. So somebody saying that this person is not 100% okay. Kuna some damages mahali. That is not somebody who can say that is fully sick. You can't disqualify that person that ni mbaya sana. No. Ako tu na shida kadogo. So, but you have to explain that there's something that you found. And so that is why we are saying, whatever you are able to see that made you not to give 100%, actually it made you to modify a report. That thing that you've seen that you are now saying that it's except for, that is the item that is making you modify the report. So that's the first way of modification. But then we have another scenario. We have another scenario where things are very bad and you have evidence. In this one, you have evidence that things are good, only a small thing in a rim. In this one, things are very bad and you have all the evidence to confirm that things are not okay. You can stand before the court and actually confirm, then that one is called adverse. Anything that is adverse, something that is bad. So that is another opinion that you can give. So in report, if you give this particular report, or you are reading financial statements of a county government of your area, and you've seen them given adverse, just know that there is a big problem. Meaning that if it is a misstatement, it's a bigger misstatement, all right? And there is evidence. But we have situations where, as an auditor, you're not able to collect evidence. Remember, you can only give an opinion when you have evidence. Lakini sasa wakati utashindwa kupeana opinion because you don't know whether things are bad or wrong. You remember the time of 207, Mr. Kivuitu was telling us that hajui nani ameshinda. So that one, he didn't have any side to fall on. Anasema tiata yeye hajui. Now that is a situation or a state that an auditor can find himself in. Whether you don't even know whether things are okay or not, because you don't have evidence to support that, then that one you give what is called a disclaimer. Unajitoa. Unasema mimi sasa hapa hakuna kitu naweza sema. Unajitoa. That is a disclaimer report. Now, back to wordings. A good example that we'll start with is here. So let me start with the first one. Sorry. Let me start with the first one, unqualified report. So some of the things that can make you give unqualified report. Number one, you are saying that financial statements represent a true and fair view position. You are able to confirm that. That is the reason why you are giving unqualified report. So in this question, they were asking you what now to give it according to what you are seeing. Just 1 minute. Okay, so sorry for that. I was assisting a colleague. So I'm saying that the question that was brought, they were asking you a few things. Let me just check again. The examiner was saying that describe circumstances, any other world condition that could lead you as an auditor to give the application, to give this kind of opinion, 2 marks. What circumstances can you give this kind of opinion? Emphasis on matter, disclaimer, except for. But they have not given us unqualified. Fine. This time they might give unqualified report. So what conditions can make you give such kind of conclusions? So we are saying that number one, conditions here is that you as an auditor, you are able to verify or confirm the financial statements. And from your opinion, you are now expressing yourself and saying that the financial statements represent true and fair view. That is one conditions or one thing that you are able to see. Number two, under this one, you are saying that you are also able to check the internal controls. Are we together? You are also, when you give this confirmation, you are trying to say that you have also been able to check the controls within the company, the controls that the customer or the client put in place, and they are also working perfectly. And so you are giving a good report. If the controls have a problem, then now we step from here, we come to the second modification, because kuna kakitu tumeona na tunaenda kusema. So you are going to modify the report. So whenever there is a problem in control, then now we downgrade ourselves and come to the second opinion category, which is called modified. Under modified, now we only ask ourselves, what is the damage? With that thing that we have seen, what is the damage that has been caused? Is it kidogo, ama ni serious, ama we cannot even say. So we are saying that number one, you've been able to say that financial statements represent true and a fair view of the company, meaning that what you have seen and what you are being told ni sawa, zinafanana. Number one. Number two, you've also checked the controls and they are working perfectly. Number three, you are saying that their financial statements have been prepared according to the required standards, right? The standards that you've been given or that are expected have been used correctly. So that one, in audit, we say that the financial statements have been prepared according to the applicable financial framework. Financial frameworks can be the standards like IFRS, meaning that they are followed strictly IFRS the way it should be, or it could be GAAP. They have been able to use that standard correctly. And you know, IFRS is basically international standards, and GAAP depends on the country. So every country have their own standards. So in this case, you are trying to say that according to you, the client has been able to use that. And so that is why we are saying that as you go to audit, one thing that you need to understand during planning, you need to understand the team, the accountants in your client's place, the management. Are they competent? Do they use the standards that are expected? Do they know that there are standards that need to be used? And are they using them correctly? And so when you're going to audit, already you know that we have a competent accountant who is a member of ISPAC. These people knows what they're doing and their history are good. So that means that as you go to audit, there is an expectation that they might be using the correct financial reporting framework. A situation where the client doesn't even have a system, they don't even have maybe a qualified accountant. Most likely, they are not going to use the right framework. If you have employed somebody who did another course and become accountant, even the financial statements might not be accurate. So that means that there are possibility that the financial standards that are expected or reporting standards that are expected have not been used. And so that is why it has an effect during planning. The competency of the team that you are auditing and the report that you're expecting to give, there is correlation. There is a relationship, right? If you have an incompetent person, possibilities of errors existing, including using the wrong standard or using the right standard but wrongly, exist. So if you give a good report, it shows that they have used the right standards. Another thing, it also shows that you actually confirm that the management have actually exercised their responsibility to keep the books correctly. You know, it is the responsibility of the management, not you, to ensure that the records are being kept correctly. So that when you're coming to audit, you don't give a disclaimer at how umeona. Huwezi sema ati hakuna kitu umeona. Everything umeona. So this one is a situation where, or a circumstance where, the client has been able to keep all the records properly. And the last thing is that they are able to avail all the information and answer all the questions that you had at the right time so that you can be able to give a conclusion. If they don't give you information, they don't answer your questions, audit questions, then definitely you can't give a good report. You can't say that you are satisfied. You need to downgrade and look at the impact of the information that you are missing. So that means that there are things that or circumstances that the client met, and that is why you gave him that report. Number one, he has kept the books correctly. He has used the required standard. He has actually given you all the information that you require. He has also kept and ensured that controls are working properly. And so from your side, you can say that the financial statement, according to your opinion, represent true and fair view. So there is nothing to actually blame the client for. And you've done your work and you have all the evidence. That is a clean understanding of that particular, that is the best understanding of this particular scenario. Then we have number two. Is there a question in number one? Is there anybody who doesn't understand when to apply number one and qualified opinion? The best opinion that you can always find. Most of our governors will always get it wrong. They can rarely get this. Very few can actually get this. Because pesa ya kaunti inatumika vibaya na ukifika unapata wamechoma finance department. So you give a disclaimer or you give advice. Wameloot. So you can't say that the financial statements at the county level represent the true picture, that what they have given you and what was expected is actually the same. They have looted the money, right? So that's why most of the county reports, most likely, you'll find that they have been given a modified report, either advice or disclaimer. And a county government which manages to get qualified will actually be praised. We are majaribu sana because there is only a small error now at 100%. So is there a question here before I move to number two? You can raise your hand. I can unmute you to talk. Don't fear your neighbor. They don't even know you. Don't fear your neighbor here. They don't even know you. Tumetosheka, just comment so that I know. Are we okay? Everybody's okay with the explanation for number 1. About the opinion, yes, thank you, Nancy. Yes. Only Nancy is okay. Charity is okay. Yes, okay. Somebody's called user. Well explained, thank you. Now, let's go to number 2. So, in number 2, we are talking about modification or modified opinion. We say that this one is where unaenda kuongeza vitu zako. So, basically, you are modifying the expectation. Expectation is ile nimesema. So, when you're going to make any change, you call it modification. Then now here we have 3 types of opinion. So, in exam, if they ask you to give the opinions, you say number 1, unqualified, number 2, qualified, number 3, number 4. But if you have time, you can categorize them and say that there are actually 2 categories. The first category is unmodified, which has only 1. Then the second category is modified opinions. Under modified opinions, we have the 3. Then you have your 4, and you are able to explain. So let's go through this one. In this one, we are saying that there is a small error. And so that is why we are saying that except for financial statement, for example, normally has current assets. Then we have fixed assets. Then we have current liability. Then we have long-term liability. Then we have equities, right? Equities. So that is basically what financial statement or financial position sometimes have. So you might find that everything else is okay. You've given all ticks. But here in current assets, there is an amount of receivable that has not been correctly posted. So probably the client has been able to post a bad debt as a receivable. So the receivable has been indicated maybe like 1 million, but in actual fact, it should not be 1 million. It should actually be maybe 7 million. I mean 700,000, sorry. 700,000. So that means that there is an overstatement by 300,000. And this overstatement means that instead of recognizing receivable, they have included 300,000 as a receivable. This 300,000 is a bad debt that you cannot receive. It is a bad debt. Now, what is the implication of this? This particular bad debt of 300,000 have actually overstated receivable. But again, because you didn't write it off, because you should write it off as bad debt, it has actually overstated revenues or profit. Because if you write it off, the profit should have gone down in expense. Ukiweka tu kwa profit pap inaenda chini, bad debt, right? But now if you leave it here under receivable looks more, but again, profit also looks more. So that means that there are 2 effects or impacts. Number 1, it has overstated receivable. It has also overstated profits, right? But now the question is, what is the implication? Is it so serious? Yes. If it is serious, then you can now say that you reject the whole report and say that the whole financial report is wrong because of only that particular error. So the whole report has a problem. But if you feel from your point, it's about judgment. It's about judgment. If you feel from your point that that is a small thing that we can always ignore, from the auditor we say that that one you can actually accept. It is a risk that you can actually accept, acceptable level of risk. Now, if you feel like this one is a minor thing, then you give it except for. So you say that the financial statements actually are okay, except for an item of receivable, which has been overstated by 300,000. An item of receivable, which has been overstated by 300,000. So then we are giving a report that the financial statements are basically okay, except for one line item. Because even current assets here, it is not all receivable. We have stocks, we have cash, we have things like short-term investments, like maybe if you invest in a CIC money market, those are current assets. Then we also have receivable. So they are not, it is not just one item, they are quite a lot. Lakini zote ziko sawa, ni kamoja tu. Sawa sawa. Sasa hata wewe, if your partner only has one problem, huwezi mfukuza aende nyumbani, unamwambia nitaishi na hiyo. That is an acceptable risk. I can live with you with that particular error or risk, but always I will see how to maneuver. So nobody is 100% perfect. So this happened with this, then you give a good report. It's not a bad report. It is a better one. It is a better one. It shows that mtu amekuwa keen na amejaribu. Tuko pamoja. Now, what do we mean by this? When you are now giving a report, you now say that a qualified report is a report that you give where there exists a misstatement. We agree that misstatement exists, but that misstatement is not pervasive. There is a material misstatement, but not pervasive. Tuko pamoja? Meaning, when we talk about pervasive, you know, if material misstatement is basically the difference between what is expectation, and the finding. So the difference between this is what we call misstatement. What you expected and what you found. So that particular difference is error. It's called error. And that is a misstatement. So that misstatement, if it is immaterial, that means that it does not have much impact. Then you give it a clean bill. Yani haina effect. That is quite immaterial. Kama maji, unaona maji sio chafu sana, unasema niko na kiu, acha nikunywe, right? So that one shows that it is immaterial. But when it is so serious that even kama uko na kiu, huwezi kunywa hiyo maji, then you are saying that it is material. So for us to bring this one from here to here, meaning that that error we could not let go without mentioning. So it was material. But then that materiality in the error does not have much damage. So the damage that it could have caused is what we call pervasive, the seriousness, the adverse level. So that one is what we call pervasive. Pervasive is the impact, right? So we are saying that underqualified, this is where misstatement exists, a material misstatement exists, misstatement exists, but not pervasive. We accept there is a material misstatement here, and that is why we can't say it is immaterial. If it is immaterial, we give it this. So it is material. That is why we are mentioning it here. So that misstatement does not spoil everything. It is not pervasive. Does not cause the damage in the financial statement. So then we are saying this one you give, or except for you give, where there is material misstatement in the financial statements, but not pervasive. Is misstatement the same as misrepresentation? Yes, sometimes it is also called misrepresentation. But when you talk about misrepresentation, meaning that you are giving a wrong report, especially knowingly, like financial statement has errors, but then you are going to stand and tell people that you know hii ndio ukweli. Na wewe mwenyewe at the back of your mind unajua it is wrong. That is called misrepresentation. But misstatement could mean that there's an error that even you didn't know. Think about a finance manager who has actually misstated financial statements. Na anajua vizuri hii nimecook. He has cooked financial statement. Alafu anaenda before the board anasoma. This year we've made a profit of 10 million. Na anajua vizuri that is not even 10 million. It is basically around 2 million. That is called misrepresentation. And that is normally a financial fraud. Right? So misrepresentation must not basically mean that it is the same as misstatement. Misstatement could be an error that you didn't know. Where could you exist? You are not representing that. You're not presenting to people. You're not presenting that in the financial statements or trying to convince people to believe that you're saying the truth. Wewe mwenyewe hata ukujua kuna shida. But then the auditor realizes that there's a problem. Hata wewe unajuta. So that misstatement does not necessarily mean that it is the same as misrepresentation. Misrepresentation could be the auditor doing it intentionally, giving a wrong report when he knows that it's wrong, just to deceive somebody or to convince people to believe in what he's giving. And that is what we call fraudulent reporting. So we'll be able to look at that. I don't know whether we've actually done it in our last class, but that is what it is. Now, we have the third category. So that means that in this particular opinion, if you were to express opinion, we have said the conditions under you give it the conditions where there is a material misstatement, but not pervasive. In this case, there could be maybe all the financial statements are okay, except a line of one item is actually having some errors or misstatement. So those are the conditions that makes you give qualified or accept for opinion. Where the financial statements are okay, but just a line item or one item in the financial statements has got error, then that one you give this. So we mean that that error is material. You can't ignore it. You can't say that you're giving a clean bill. It is material, but then it doesn't have a much impact. Now, when you talk about materiality, what does this mean? Materiality, I normally say that materiality is a judgmental concept. And I give example with a scenario. It is about judgment. So what you can take as serious, somebody can ignore. But that also depends on the level of risk that I'm able to take as an auditor. I can actually ignore that 300,000 and just give a clean bill because I'm ready to take that risk. You only one deal, you only error in exist. But then I'm ready to say that that was a small error. Because to me, it is not material, it is immaterial. That is why I'm saying materiality is a judgmental concept. So whatever you can see as good, somebody else is seeing as bad. Whatever you're seeing as serious, somebody else is seeing as not serious. Just like in a relationship, you might find some of our friends whom ukimkosea mara ya kwanza anakuforgive, mara ya tatu anakuforgive, hata mara ya 10 bado anakuachia. Lakini kuna wale wengine hata ka small one, siku moja tu amepaka naenda, because according to him, according to her or him, that is material. Mwingine anasema sasa mtu nani anatoroka juu ya a small error, lakini wewe mwenyewe unaona that is serious. So that is why we are saying materiality is a judgmental concept. But then, even if it is judgmental concept, it should not be having a discussion where there is an obvious opinion. For example, when you are telling me that income statement has been overstated by 30%, surely, even if you are telling me it is immaterial, hata mtoto mdogo ataona tu hii ni serious. Naona, wakati kuna kitu imekuwa juu sana, then even if it is about making judgment, your judgment should not contract almost everyone. That is why we are saying it is a judgmental concept. But then, in exam, they will give you a scenario where you are comparing materiality, but the situation presents itself in a way where you cannot manage to go opposite the expectation. Kama ni mbaya ni mbaya. Ndio kuna zingine mtu anaona tu hii ni obvious. Hii ni obvious, right? But kuna zingine mtu anasema hii inaweza kuwa hivi, inaweza kuwa hivi. So that one you are allowed to debate about it. That one you are allowed to debate about it. What about opinion on negative assurance? Negative assurance. So when you talk about these particular opinions, then these are now what is called positive assurance. Negative assurance is where you are giving a limited assurance, where, or we call them negative opinion. You are not very sure, right? Because hata wewe mwenyewe unajua hujafanya kazi nzuri. Those are in a different level. Now that one we normally talk about it when we talk about levels of assurance. When we talk about level of assurance, we normally have positive and then negative. Especially, this one is in audit engagement. This one is in review engagement. In review engagement, we have limitation of scope. Limited scope. What does that mean? Umeenda kufanya kazi lakini mkono imefungwa. Haujapata information fully. So even if you are giving a conclusion, wewe mwenyewe you are not confident of yourself, right? But in this one, in audit, you must have gotten a chance to give the correct conclusion because you are confident of the work that you've done and you have all supporting evidence. And so these opinions that we have here, they are applied in audit because in audit, there is a possibility that full information you are given full information, and so you can confidently defend your opinion, whether it is good, it is moderate, or it is bad. You have the scope. You are able to audit and you are able to come with conclusion confidently. So that one is called positive assurance. In fact, in these ones, the sounding of the word, when you're giving positive assurance, you will say, in my opinion, you own the opinion. You say, in my opinion, the financial statements represent. In my opinion, the financial statements do not represent the true picture. You know, because when you're giving, for example, advice, you can't say that they represent. You'll say that financial statements do not represent. But in this one, we'll say that the financial statement represents whatever except for, right? So that is what we mean. So you are positive, right? But in negative, you didn't do enough job because maybe the scope, mtu anakuambia fanya hii kazi lakini fika tu hapa usiangalie, then you give conclusion. Hata wewe mwenyewe ukimaliza unasema tu hapo naye sidhani kama nimefanya kazi nzuri. So the only conclusion, of course, after that audit, you might have not, after that review, you might have not gotten a mistake. So you can't say that the financial statements are okay. But again, you cannot say that the financial statements are not okay because you don't know what is lying behind, what is still there that you should have checked. You are not sure. So because you are doubtful, you now give an opinion that is quite not confident. That confident opinion is quite, the confidence in that particular opinion is actually low. That is why you give a negative. And in this one, the tone will always be like, nothing has come to my attention. You know, you don't now say that, in my opinion, no. Sasa unasema, hakuna kitu imekuja kwa akili yako. Ama, from the process that you've gone through, nothing has come to your attention that shows that financial statement do not represent true and fair view, right? That one, you're now coming from the negative point because it is like something was supposed to come to your attention, right? You are quite negative. Mtu akisema, nothing has come to my attention. That means that something should have come to your attention, right? But in this one, you are saying the financial statement, in your opinion, the financial statement do not represent. You are very specific, you are very direct, positive, and confident. In this one, nothing has come to your attention to show that the financial statement do not represent true and fair view. Meaning that according to you, you are quite negative in your wording, in your attitude, and even in your belief that in fact, things should have been bad. Something should have come to your attention. So that is the difference between negative and positive. They are also given in different levels. This one is given under audit. This one is given under review. Positive is given under audit. Negative is given under review. Okay, so I'm hoping that you're getting some. Now, when we come to adverse, this is where material misstatement existed, and that's why we're modifying. But that misstatement is also very serious. It caused a very serious impact. So we are saying that the material misstatement is, we are saying that the misstatement that existed is material and pervasive. The misstatement is material and pervasive. Here, the misstatement is material but not pervasive. Here, it is material and pervasive, meaning that it may exist and it is very serious. So that is the implication. So in the implication in this one basically means that the financial statements are actually bad, right? Sio mzuri. But in this one, the report is not badly off. So that is the difference between the two. In fact, these guys just wanted you to define because they could give you 1 mark. Now wanakupea 2 marks to define, alafu wanakwambia ati tell us the implication. The implication is basically that the report is going to be bad or good. There's nothing much, right? Now we have a disclaimer. Disclaimer is where you are not able to access the financial statements fully. You can't get all the evidence. Remember, we say that for you to give a good report, you are able to audit and collect all the evidence that were required. And so you are confident that all the information that were available to you were enough to give a right opinion. In this case, you are not given anything. Here, haujapewa kitu, unaenda unapata ofisi iko hivi, hawana file, hawana system. Sasa, we say that they are bad because you do not confirm. Maybe hawajaiba, lakini ni tu wako lazy. So you can't say that the financial statement there was a fraud, there was an error. You can't say it. You know, I want you to understand me very well. When you are giving this particular report, a disclaimer, this one ni kujitoa because umeshindwa kufanya kazi and because of limitation of scope or because of lack of resources. You know, you can go and work, but then you're told that ofisi ya manager usiende huko, ndio manager ndiye ako na hii. We can't do this. You can't do this. You know, you are limited you are actually limited in terms of scope. But then there is also a possibility that you are free to visit everywhere. Lakini hata ukivisit, hakuna information unapata. So you can't actually be able to verify because we say, with audit, for you to give an opinion, you must have had the evidence. Kama una evidence, you can't tell us that they are okay. You can't tell us that they are bad. So those errors that do exist in financial statements, they come either as a result of a normal error, maybe like posting walisahau kupost, that is an error. Pesa iliingia kwa account lakini hawaja recognize in the cash book, that is an error, right? Or waliiba intentional, right? So in these cases, in all these cases, there are a possibility that as an auditor, you are not able to give a correct figure. You can't accuse them that there is adverse. You can't tell them that there is a misstatement. Because we mwenyewe hakuna kitu umeona, but haujaona because you didn't have evidence or you are limited in terms of scope, meaning that umefungiwa tu mahali, huwezi enda beyond that. So in these cases, you can be able to explain very well. That disclaimer is given where there is a limitation of scope or there's lack of information. So the auditor is not able to give an opinion, to express an opinion. Hapo anajitoa, na kujitoa ndio tunaita disclaimer. I know you guys have seen sometimes when people actually play some nice music for Facebook, anasema tunatoa disclaimer, hii music sio yangu, I'm only using for entertainment reasons. So that means that anajitoa in case mtu akuja claim that you use my song, you use this one, anasema no, but I said I don't own it. I don't own it. So in this one, the same way, you are not giving any opinion, unajitoa. So let me look at the last part that they gave us. They also gave us something here. Watu walikuwa na kupima tu. No. Which one is it? That question paper. Kwani imeenda wapi? Question paper. Okay, sawa. Got it. Now, the last thing they were saying, except emphasis of matter paragraph. Now, I don't know who set the question, but those are not audit opinion. That is not an audit opinion. I don't know who set this question. Maybe it's not an auditor, but the audit opinions are all legal form. Emphasis of matter paragraph is not an opinion, but I know that it's something that I have taught and I'll teach again. So it's not bad if they set it. You really need to understand what it means. So we are saying, from the word emphasize, that means that basically to give weight or to emphasize, basically to give weight, emphasis. Now, sometimes you can be doing audit. Then after doing audit, you realize that there's something that you just wanted people to know. You want to mention it and put it in bold or underline or red so that mtu ajue vizuri. Like for example, if there was maybe there was something like maybe there was a fraud that happened, right? Some serious fraud, and you want people to know that the company has a problem going concern. Kampuni haizi endelea vizuri. So as much as you might be giving an adverse opinion, but you might want something just to display to people wajue tu. Wasione tu kuna ka opinion na wajui what is behind the opinion. Wanataka tu, unataka kuelezea vizuri, ndio waelewe mbona umepeana this opinion. So that somebody cannot blame you in future, but you didn't tell us. You only gave adverse, but you didn't tell us why it is adverse, right? So you put a line called emphasis of matter paragraph, where you're going to put or write something that is quite outstanding out of the findings. When you're doing audit, kuna vitu utapata. Out of those ones that you find, there's one that is quite serious that you want the users of the information to pay attention to, all right? That you should have even put in red or in bold. That is what we call emphasis of matter paragraph. It's a paragraph that contains some of the important findings, the most significant finding that you got during your audit procedures, right? So it's normally part of the audit opinion page. Let me show you an opinion, how it looks like. I know some of you are just been seeing or hearing that audit opinion, but they don't know. Let me look for one, just a sample. Which opinion can I give now? Let me just do that and then we can disappear. I know you guys are also busy and I don't like disturbing busy people. I don't like disturbing busy people. But allow me to show you that. Just hold on. I'm sorry for that.